Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, so hi guys, welcome back to the channel. So for those of you who are new, this is the Greedy Trader channel where we talk about all things trading. We focus specifically on market profile, volume and liquidity. There is nothing else you need to bother yourself about beyond these two concepts. One, where we're going to find liquidity. Two, where the bids, where the offers, and we can use market profile to find that. And what's the volume, right? So what is the demand and supply picture? Where are those key demand zones? Where are those key supply zones? What do we need to know in order to be able to capitalize on all of this? And that is primarily our focus here as a channel. Now we're aware there are a ton of channels trying to teach similar concepts, or they're trying to teach concepts that are complete BS, right? We know there's a lot of stuff out there on the internet, but if you're here right now, as you can see, we're a very small channel. We rely on you to help the channel grow, and that's why it's important to us that we're giving you the raw facts. Now, I've been a trader for well over 15 years, both the institutional space as well as the retail space, so I know absolutely what you're going through as a new trader or a retail trader, and I also know what institutional traders do that you probably don't do, and that's probably why it's holding you back. For those of you who know me and have followed me for a while, I've got a private Discord server. Everything I provide is completely free, and if you've gone there, you see what I've done here on YouTube. Also, you would know some of the other things I do, like I sell option premium, and you know that gives me steady weekly income, and I do pretty well from it. I also trade occasionally if I see an opportunity, and I'm going to show you some of the strategies that I use, and when I see these opportunities, how do I go about getting them. I'm a huge equities trader. I manage a fund, and I also occasionally will dabble in the FX market or the futures market, depending if there are opportunities there or not. I am not a degen. Everything I do is methodical, and I'm trying to get you guys to think in the same way like a professional, so you're not just in and out of stuff. Now I know you guys love Forex, so I felt it was really important that I did this specific video, and I was going to focus on this one single strategy, this one single Forex trading strategy that if you used it and you did this repeatedly, you are going to be profitable.
Oh yeah!
Now most people can't make that claim for you. If you do exactly what I tell you to do, you're going to be profitable. Because what I'm about to show you today is based on the concept of selling at a premium or buying at a discount. Most traders don't understand that this is what they need to be doing, or they're trying to get to that point, but they've been led down the pathway of things like trend following, all these little catchphrases that you find out there that is done by all these people claiming that they're traders, and you know, there's just so much BS, guys, and it is really, really sad.
Once you see that shit, it'll fuck you up for life. Good luck, have fun.
But there's nothing I can do about it. If trading has a very low barrier to entry, and because of the low barrier to entry, you're gonna see people, and there's money involved, you're gonna find people who are gonna bring all this charlatan stuff. There's nothing anyone can do about it. But you as a trader, you need to be aware of this, and you need to be aware that if people are showing you stuff, do you have the ability yourself to back test that? Question number one. Two, what they're showing you, is it provable? Are they able to show you on the charts, right? Not just some talking head video. Are they able to show you consistently on a chart how this has worked, right? Are you going to be supported as a trader? Is there an area where you can go and get more information on this thing that's been put out there, right? Do you have they shown you enough, right? Or is it just a marketing video? Have they shown you enough that you can go on and practice this yourself and come to your own conclusions? These are all foundational principles if you're going to help people achieve. Now for me, you guys help me grow the channel. I give you my 15 years plus knowledge in the market that you can go away and make something better of your lives. I'm not a talking head. This is a faceless YouTube channel. It's faceless for a reason. Here we want to focus on what matters, right? That is success, trading, making money. We don't want to focus on the other stuff, right? I'm not intending to be an influencer. I don't need to be an influencer. That's not what I want to be. What I want to be able to do is build a community of guys that can come and get reliable information, and they can go on to succeed in their own right? And at the end of the day, what goes around comes around. That's what I believe. Anyway, guys, onto the video. So today we're going to talk about this single Forex strategy. It's so simple, and it's gonna shock you how simple it is, right? And it's gonna shock you how many professionals in this business, they look at this market in exactly this way. It will shock you, right? So let's get on with it. So the first thing that we're gonna need to have is a simple Fibonacci tool, right? So I'm just gonna pull that across on the screen. Right, actually, let me do that. Let me narrow it down a little bit. Let's bring it lower. Right. So it's a simple Fibonacci tool first and foremost. Now there are a couple of ratios we want to put on the tool initially, right? The first ratio is the 88.6. The second ratio is the 127. The third ratio is the 161.8. And the fourth ratio is the 261.8. And I'll tell you exactly why I'm saying that you need to set your Fibonacci tool this way. Forget about all the other stuff that's on a Fibonacci tool. Get rid of them, delete them. They don't matter. Totally of no consequence. The only thing you want to focus on is this. And I'm going to explain to you why. So then the next step in this model is a really simple step. Now, when we visualize a market, we're normally looking at the market either in a range or in trend. I think we can all agree with that. And within those ranges and trends, you have peaks and troughs. Now, those peaks and troughs are just a representation of the direction of the order flow. So if the market is going higher, it means that prices have been offered at higher, right? Then effectively we are in a bullish trend, and prices have been offered higher in that trend. We should expect that trend at some point to correct as a result of profit taking, or we just run into a liquidity area where stops get triggered. And we already understand, I've got a ton of videos on liquidity trading, so I'm not going to talk about that right now. The focus here is primarily on this single strategy that anyone, whether you're a beginner, whether you're an advanced trader, if you're not getting the kind of results or the probabilistic results you're looking for, then this is what you need to be focused on. Right, so again, we expect that the market is going to correct at some point, and it's going to resume its trend, or it's going to correct into a discount area, and then it's going to move to a premium area and recorrect. So in other words, it's going to stay in a range, right? And these ranges are going to happen over the short term, the medium, and the long term. Today, I'm going to focus primarily on the 4-hour chart, right? This can be applied to the daily, 4-hour, and the 1 hour. I wouldn't use this on any time frame below the 1 hour, because the 1 hour connects with the intraday, with the daily profile. For those of you guys who followed my market profile videos, you would see that, but I'm not going to talk about market profile today either. And this is the focus of this video, is primarily this simple trading strategy that everyone should be able to do. Right. So first and foremost, and let's see an example of that. So I'm going to take this cross section. I'm going to really expand the chart out here because I want everyone to really see what I'm trying to say. And I really want you to digest this, right? So we've got an example of that is we've got a huge swing low, we've got push up, a correction, higher lows, continue. So we've got this trend set up like we're rising in a channel. So we're going to look at this historically, and we're going to look at this in a current context. So historically, let's go back to the 16th of February. So we can see that we had this red candle, 4-hour candle on the 10 a.m. 4-hour window session, right? And we had this pullback. There's not a lot of volume accompanying it, to be fair. It's just a pullback, right? And then we close. And then we start to go higher, right? So the next window, the 2 p.m. window, we start to go higher. Now what we want to be able to do is we want to run our Fibonacci tool from top to bottom, right? So when we run the tool, we go left to right. Right, so left to right. And what that is doing is it's measuring the downswing, and then it's looking at the upside swing from there. So the first thing we've got is we've measured the tool, we've put it in place, so we've got an idea of where the sellers are. So on one side we have buyers, on this side we have sellers. The sellers have pushed very low and now the market is rebounding. Now the sellers who are short, if we take the principle that the sellers got short, they had $0 here, and let's say they have $1 million here. If the market pulls back to this 100 line, that means that any $1 million equity that they had accumulated, remember they're starting at 0.0, right? So we're assuming their capital at that point, let's say they had no capital, they now have $1 million in capital, right? That is like the ideal, right? We know that of course most people will have a starting balance, so you need margin obviously to take these trades. So this is not a very realistic scenario, but we're going to use this as an example for simplification purposes. Obviously if I start putting in, say, well, let's assume you have $1 million balance and then you made $1 million in equity, it doesn't quite look the same, right? So let's assume that they have enough capital to take the trade, but they're $0 and now they're going to $1 million, right? So now they're $1 million up, right? And then the market reverses and pulls back. If it goes back to the zero line, then they are $1 million down, right? So they're back to break even, they're back to zero, they're starting. Now think about this. If the market now pushes beyond the zero line, these guys are going to go into negative equity, right? So they have zero and now it pushes past the zero line. So let's say it pushes halfway past the zero line, which will be the designation 150, right? On the if you were to put 150% on a Fibonacci tool, right? So 1.5, that will mean that they've now gone into negative equity, let's say $500,000, right? Now if it goes to 200%, then they're now in negative equity to $1 million, right? So we're thinking about everything in financial terms. That's how professionals think, right? They don't think about it in arbitrary numbers. It's money. So if they push to 161.8%, that means that they're now 61.8% in negative equity. So that's about 610K in negative equity, right? So this is how we're looking at it. So what's that telling us? So that's why we have the 161.8, because traditionally we find that this is a very massive squeeze point for people in negative equity. So the margin calls tend to come at that point. So if a group of traders have been heavily short against another group, and then the market starts to go against them, we're searching for where their squeeze points are going to be. So typically we look at the 127. So that means that they've been squeezed to up to 27.2% negative equity, and then they're getting squeezed to 61.8% negative equity, and then eventually they're going to get squeezed to 100% negative equity, right? Now at that point we expect to flip, right? There's only so much pain an individual can take or a group can take before they need to get margin called, right? They can just get triggered out of the trade, or maybe their stops very deep and then you're going to trigger a lot of stops. Whenever that happens, you're going to expect that there's going to be big money who are going to take advantage of those premium prices. So let's take a step back. So if the traders here were short, and over here prices pushed into a discount and buyers took the market up and squeezed these traders out, then these traders are going to have to get out of those trades. They're going to have to buy back their positions at a premium. That's why they're losers, because they're now buying back the position at a premium at a much higher price. Now if they were able to buy at a discount, then they won't be in a losing position, because the traders who are long, they're able to sell at a premium, right? So they're able to sell to those traders who are losing. This is really important. So if you are buying at a premium, it means you're a loser, because someone is selling to you at a premium, and they're most likely making money because they're taking profit. They were able to buy at a discount and they were able to sell at a premium. So the sole purpose of the Fibonacci tool for me at this point is to tell me whether the market's at a premium or a discount. I don't care about anything else about Fibonacci. In fact, I don't even want to know anything about it. It makes no difference to me. I just don't care. It's not something that factors or is important to me or has any methodology. I just don't care. What I do understand though is numbers, and I do understand that these key Fibonacci points, right, at these key Fibonacci points, 27.2, so it's denoted as the 127.2%, the 161.8 and the 261.8, these are major squeeze points for traders who are going, that the market is going again. Now, there is no sound logic other than financial pain as to why people get out at these particular levels and why they're going to keep holding. So let's look at a couple of examples. So we've run our Fibonacci tool, and then we can see as we drove into the 127, that was about late at night, 10 o'clock, the market started to struggle, and you can see that here. Now the ideal strategy will be you would place a limit order, a sell limit order into the 127 with stops just above the 161.8 yourself, right, to protect, and then you're looking to go short, right? So that's typically what you're trying to observe, is that you see that, you go short, and that's your play. Now in terms of how long you want to stay short, now one, you could look to get short into short-term liquidity, which would be this level here, which was just under 125.89. Remember, it's a 4-hour chart, so these are pretty big drops. Or you could look to get short into the lower third of this bar, which had a lot of volume. So now we can start adding a few more concepts on top that we've learned before, like volume, for example. As you say, we focus primarily here on volume, liquidity, and market profile. So because we know at the lower third, especially in currencies, we're going to have a lot of bids stacking, which we learn in market profile. We can put that as a volume area. So this again is a strong demand area. Traders were buying at a discount, and this has pushed it up. So we want to maybe short the market into that level, and then we want to cover and get out of that trade, right? So that's how we handle targeting as a professional. It's not a factor of, oh, I need 10 RR, I need 5 RR, I need 6 RR. That's all just BS.
But that's just bullshit.
Right? You can't predict how much money you're going to make. What you can do is take profit at a place where there's high liquidity, where the market is likely to fill it, and it's going to pause before doing a runaway move, and that's where you want to get out of the trade, right? So again, that's an example there, right? So we've seen that with the 127. Now personally, point in case, I like to sell at a deep premium, right? So I'm looking for the 161.8 plus as my level where I want to get involved. I don't necessarily like to sell anything under the 161. So again, we can see that swing here. We had a pullback and then we continued higher. This gives us an opportunity to run our Fibonacci tool against this and then look again for a premium. So as we drive into the 161, like I said to you guys, the 127 was a great example, but it's not enough of a squeeze point for me. And why is it not enough of a squeeze point for me? Well, that's just common sense. It's like these guys are 27.2% negative equity. So let's do the example in numbers. If they had $1 million, they'd lost $1 million. So they were $1 million up, they're now $1 million down, they're now break even. And then the market starts to move against them. Now they're 27.2%, right? 27.2%, that's about 270K or 272K. They're 272K down, right? That's not a lot of pressure, right? They're just 272K down. They can handle that. Now, if they go to 61.8% down, so that now they're 610, right? It's crazy. There's 618, I should say, 610. There's 618, right? So 61.8, 618K down, negative equity. That is a more likely squeeze point, right? Now, I'm getting the sense that these guys are going to get shocked. Now, other things I can bring into play, like I'm going to stick a limit order here, right? Now, is there anything else that's standing out to me? Is it close to a liquidity high? It is. Am I trading probably where they're going to be offer stacks? Yeah, we can see that here, that with this candle here, if we divide it into thirds, the upper third is likely going to have some sellers up there, right? And you can clearly see that because the market did go down, right? So this is going to be an area of strong resistance. But the 161 is crucial. So how do I want to play this? Well, really simple. I've got my limit order here at the 161. Some people like to hold it just below so they get the fill, right? But you can stick it here, you can get it close. And then you want to make sure that you get it above, let's say the 200, right? Right, so if we add that to that Fibonacci tool there, it's not a huge number of importance, but I wanted you guys to, so if we stick that on here, right? So we can have some idea of stop placement, right? I just want to sit above the 200, right? And then what am I looking for from that level? I'm looking to trade this again where we're likely to see bids accumulating. We divide this candle into thirds. We're probably the last third is where we're going to sit for profit takes, right? Sort of down here, right? So this will be a good way to play this. But the thing with this strategy is that you've got to set limit orders. Market orders will drive you nuts. You're not going to be able to do it efficiently. You're going to get in at a poor price. So you have to preempt that you're trading off squeeze points, right? And historically, and I want you guys to go back and I want you to back test this. I want you to take my word for it. I want you to sit here, watch this whole video, and then say, well, this guy said this. Oh, I'm not sure. I'm going to think about it. I've got another guru who is telling me this strategy. I don't want you to think like that. I want you to go away and I want you to have a look and back test this yourself. Now, I primarily prefer to use this on cable, right? Because I know it works on cable. The thing about the markets is that you got to find an edge. Right? And for me, this is an edge, and this edge works on cable. It may well work on another asset class that I haven't back tested it on, but that's your job. You go away, you back test it on everything else, and if you find it works on other asset classes, great. But the way Forex works, and particularly the British pound, this is an ideal strategy, right? That's all there is to say about it. You know, we're not going to be able to put any more meat on the bone beyond that, right? So this is again what you're looking at in terms of outcome, right? So again, you can see that here. So you can see the market pulls back and then bases into where they're likely to be bids, and how can we find this out, right? So let's take away some of the arbitration around all of this, the arbitrariness. We can find this by using a market profile tool. If you took a market profile tool, so for example, let's just pop one up on here now, you can see where the bids are, where the bid stacks are, you can see where the offer stacks are, right? And so you can see where the strength is. So you don't necessarily need to sit here and work this out on a candlestick and make some guesswork. You'll actually be able to see if they're bid stacking. And if they're bid stacking at the bottom, that is where you want to get out. And if you don't know what a bid stack is, I've got a ton of videos on market profile and I explain this in so many videos. You should be watching my channel from video 1 to video wherever, right? And that is how you're going to learn. In any case, moving on. So that's kind of where we want to get out. So we can see that base, and then we see a further push to the upside. So let's move our Fibonacci tool again, right? Run it from top to bottom. Same scenario. The traders were short. They're short into the bid stack. They're covering their shorts, right? Now let's assume that somebody's getting short at the bottom, right? And now their market's moving against them. So the guys who were short here, 0. 1 million up in equity. Let's assume they don't take profits. The market moves against them. They're back to break even at the 100. Now they're going into squeeze territory. So we blow past the 127.2. So they're 270k down. We move up to the 161. Now they're 618k down. If we go any higher, we're in very deep premium territory. So what are we trying to do? We're trying to sell at a premium. We want to take advantage of those guys who are getting squeezed. Guys, this is what trading is about. It's about you taking advantage of your opponent when they're in a really difficult position, right? It's kind of, and it's very sad to say, but it's like in the real world. You know, you see someone who's homeless, they've got nowhere else to go, and then you just take advantage of them. That's what you do in trading, right? But in real life, you know, you don't do that. You give the guy a leg up, and you know, but this is not what happens in trading. So if you're of that mindset that you want to be a herd mentality, you want to be doing what everyone else is doing, so you feel like you're part of a group, and we're all riding the trend and all that, kumbaya stuff, then sadly you're in the wrong business, right? Because the other guy, right, the professionals, they just want to take advantage of you every day. They really do not care.
Well, then it's a good thing your feelings aren't a fucking priority.
If you're in the city, for example, Square Mile in the UK, or you're on Wall Street in the US, I mean, you go into some of these environments, some of these big banks, you know, you'll see people, you know, with like, you know, 100 quid, and you know, they probably use it as toilet paper, right? That's the reality of it, right? You know, these guys, they're not thinking about the world in the same terms you are. If anyone who's probably listening to this and maybe interned at one of these places, I mean, you know, please, if you know anyone who's interned at a bank, ask them what they go through. You know, there are going to be points where someone might ask you to buy lunch for everybody on the floor, right? Like everyone, like 100, 200 people. And that's what your day is going to consist of. So the reality of this scenario is that these environments are like super toxic. They're made up of toxic people. They're made up of people who are probably born with a lot of silver spoons in their mouth. You know, the reality of these are the people who dedicate their lives to taking your money, right? So if you're going to make a difference, if you're going to do it better, then you got to start taking on board some of this stuff, right? So again, what are we looking for? As we push into 127.09, again, we want to stack a limit order. You kind of want to have it just below, right? So you get that fill, right? Because these are once in a blue moon opportunities, as you can see, right? So again, where are we looking to get down to, right? So we trigger there. Again, what's a good place, right? We've seen the big flow off. We should go back to the lower third, right? So again, we look at the candlestick just on the base. Here we're assuming it's a bull trend, that we're not going to break any of these lows. So we just want to short into that trend. So we go third, the lower base should be bids, and that should be our target area to get out of the trade. You can see within the next 4 hours, we were really close, and that gives us the idea that that's as much as we want to do with this. Right? And then we're done, right? We get out, cover those shorts, and make for the door. So we can see here that realistically, we had at least 2 trades, right, that met my criteria. If your criteria was to execute on the 127% trades, right? I mean, and I don't see why it should be a criteria, for the simple reason that there's just not enough squeeze there. I mean, personally, it's not a level that I will look at. I mean, I would need to see a very deep correction to consider that as a potential squeeze point. But again, that is not a level I will look at. I'm looking to sell at deep premiums. That's what I always say. Sell at a premium, buy at a discount, right? Selling at deep premiums and deep discounts. Now, of course, what else do we see on this particular trade? There was some reinforcing mechanisms. So as a trader now, here's where you can build in some reinforcement. So you can start to now say, well, this is a liquidity high. We spoke about liquidity high on a 4-hour time frame. This is going to be a big level. So it means that we're going to see stop triggers. So that makes it even more ideal, right? So this gives a higher score to your trade, right? So you can now start to think, do I want to level up more on this trade, right? And that's how you make money. Right, you might think that, okay, you know what? I normally go in with 4 or 5 lots. Maybe today I'm going to go in with 10 lots, right? And this is going to be it, right? I'm going to still put my normal risk parameters in place, but I'm willing to risk a little bit more from what I've made in order to make a bigger return, right? So those are where those key decision-making things start to come in. So you can see that here. So again, we're looking now to see, is there going to be any more upside? Obviously, we base down, we go, but we failed to put in a new high. So question, is this really, so let's just do this again, just so we can see what's going on here. So if we were to level this, we're testing the 88.6. Is it really a premium? No, it is not a premium. What we're doing is we're looking at what a potential failure to do a new high, but we don't want to trade like that. We only want to trade at a massive premium, which means we need to be above the prior high. That's my criteria. Some people will look at potential failures and try and react to them or preempt them, but it's not a wise strategy, right? It's not something you want to do, because that is not a premium to sell from. Neither is it a discount. So I always say to traders is that if you are buying this market to the upside, you probably also made money. But the probability that you were going to be wrong was going to be higher, for example, because none of these prices were realistically a discount, a major discount, because they were not putting in new lows. Where the opportunities for me came, and they came more with a higher probability locked in, right? So the probabilistic nature of trading means that the focus also has to be on the probability side. If it's not, then well then you know what time that is. So again, for me, this is not a trade opportunity, right? I can't see one. So what do? I don't trade. I just wait, right? So this is where the discipline comes in, right? I want to see a real opportunity. So again, we see now we start to do lower lows, or lower highs, I should say. Lower lows and lower highs. So again, we can run our tool and see, are we going to get a deep discount? Obviously, in this case, we trade into the 127 and then we bounce. There was some reinforcement. It was a liquidity low, but it doesn't meet my criteria. I need to see a very deep premium. So the market's now moving higher. When I look, I can't see any more swings, right? So there's nothing to trade against. Of course, the traders who are long here, they've been squeezed, and they were squeezed out of that trade early. We've got some demand here for sure because we can see the volume, right? So we can start to map out a decent amount of liquidity. We talk about thirds, so if we break this up into thirds, then we should see strong bids sitting around about here. So this market is pretty much going to go higher. So now, how do we position to take advantage of what's currently happened? Sadly, we've had a few, not sadly, but we just haven't had any trade opportunities that match our criteria. So what are we going to do? We can then look at swing high to swing low, left to right. Now we're working against a bigger time frame, right? Because we can see that the sellers have been short longer period of time. It's playing into a bigger time frame. And now the upside liquidity, I'm looking for a deep discount. I'm not comfortable with just the 127 here. I'm looking to go into that big level, but this will be now into a daily time frame. As you can see, it's a really big wide swing. I can't see any minor swings, and if I do see minor swings, I can then now start to look at those. So what I'm expecting is that in due course we should get a correction in cable, and that should correct into what we should call reasonable demand, right? So we should start to pull into a demand area and then bounce off that, and then I'll be looking to see if I can sell at a premium, right? There is a chance that if you wanted to trade the demand area, it's a lower probability trade, so you can just risk less, right? So we can see a lot of demand here. If we get a nice pullback and we base, then you can check, right? And that's where it becomes important to check whether we're going to go into a demand area at a dip discount. So depending on where the correction is coming from, for example, then we're either going to trade into the 88.6 where we're going to meet demand, or if we're coming from a much higher price, then obviously we're going to be trading still into these kind of levels. But like I said, it's not a high probability trade because we've said time and time again, we want to see at least a grab for liquidity, and that means you're going to look for a deeper discount, right? So I prefer to look for, right? So a trade below the lows if I'm going to be a buyer, right? But none of that is showing up right now on cable. So what do? We sit on our hands. Have we made money? Yes, we made decent money. We had 2 trades over the past couple of days, and that's decent enough money. What's the problem with sitting on your hands? To my next video, guys. Adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?